The start of reporting season pushed worries about China and falling commodity prices to one side. The ASX had more of a domestic focus on earnings and dividends, with banks and consumer stocks in favour. Retail sales for June came in better than expected and Suncorp's result went down well. CSL hit $100 a share and we'll be talking to them tomorrow night. Going the other way today were energy stocks. Asian markets were mixed. The Chinese regulators have again tightened the rules on short selling, and the Australian dollar jumped more than 1% after the Reserve Bank left interest rates unchanged at 2%. Roger Montgomery from Montgomery Asset Management is in the studio with me, and he joins me now. Roger, we saw from Wei Feng-Tay's piece out of China that property prices there are falling.
Yes.
So does that mean there's going to be a lot less construction and therefore a lot less demand for steel?
Yes, and in actual fact, it's uglier than many people realise. The residential property sector commands most of the demand for steel in China. China in total is producing about 839 million tonnes of steel per year and only consuming about 728 million tonnes. What this means is there's 111 million tonnes of steel that they don't need being produced every single year, which is being dumped on the global market, with repercussions obviously for iron ore.
And in terms of the iron ore miners, in particular, the two marginal producers, the ones that have the highest cost perhaps, are Brazil's Vale and Australia's Fortescue Metals Group. They are in a lot of trouble if this situation unravels further.
They are. If you look at Vale, for example, in the last 6 months, their sales were down about 17 or 18%. Free cash flow is down significantly more than that, about 56%. They're now free cash flow negative. They've got massive leverage. And perversely, what that means, that large amount of leverage means that they have to continue producing more iron ore to amortise that interest expense, that very high fixed interest expense, across more volume. And so despite the fact that the iron ore price is lower, these marginal producers are being forced to produce even more. And that's going to push the price down even further than it has already.
Well, someone who may be in a slightly better position, although is still feeling the pain from these lower iron ore prices, is Rio Tinto. Its result is out on Thursday. What are you expecting?
Well, we're not that interested in the result now because we know the result will be worse than last year, which was worse than the year before. What we're looking for are the comments about the future. But we've already spoken to ArcelorMittal, we've already spoken to Vale, we've been in on conference calls with them, and where previously they thought we'd reached the bottom of the market, they now believe that things aren't going to improve for more than a year. So we think it's going to be a dour outlook, and investors should be very, very cautious about believing that the stocks are cheap now.
And in terms of investing in these stocks, should investors be looking for that big cash dividend payout that we've seen from obviously the financial sector, but miners have been fairly generous as well when we're thinking about Rio Tinto?
They have, but dividends are driven by earnings, and the outlook for earnings is negative. So I'd be more concerned about, one, the fact that their earnings are going to drop. Two, all your other investments that aren't exposed to offshore earnings, you need to look at those as well, because the Aussie dollar is likely to come off a lot more.
Okay, and just very briefly, how long do you think this commodity rout has to run?
Well, we're at $40 roughly now, and I remember talking about $40 on this program when it was over $120 a tonne for the iron ore price. I think now we could see the price going to $10 or $20, which is where it was.
$55 today.
55, but it doesn't matter. For 40 years before 2002, the price ranged between $10 and $20 a tonne. I think we're going to see those levels again.
Okay, Roger Montgomery, we appreciate your insights. Thank you.